In our generation, there are generally two schools of thought when it comes to growing your wealth in Singapore sustainably. The first is to consistently invest your savings into stocks, often through strategies like dollar cost averaging. The second is to purchase a condo for rental income and for long-term investment. There have been plenty of analysis focusing on either of the two strategies, but they've always been in isolation. Very few have done a true like-for-like comparison between the two. I've ran the numbers for an investment condo factoring in everything: interest, hidden costs, leverage, and upfront expenses. Then I compared the total returns that you get if you simply put all this money into a low-risk stock portfolio instead. By the end of this video, you understand why this dilemma is becoming more and more crucial for our generation. And you also understand which option is likely to yield you a better return after 15 years. You also get to see which of these two options is the overrated one, and why one of them will always have the long-term advantage. So you can decide for yourself where to park your money. Real estate has long been the default investment of choice for many Singaporeans. It's viewed as stable and familiar. You can leverage your capital, earn so-called rental or passive income, and even have the chance to grow your capital. But it is not a perfect strategy. There are certain drawbacks, especially when we compare it to something like stocks. I won't dive into the qualitative aspects here as I've already covered them in another video, which I'll link above. In this video, I want to keep things 100% fair and focus purely on the investor and not so much on the asset type. That means I'll be using the same amount of capital over the same schedule for both the property and the stock investment option. I'll be tracking every dollar spent on the property option, including all the hidden fees that people always talk about. And then I'll be modeling what would happen if that same amount of money had been invested in stocks instead. But so far, in my previous video, it's been purely a qualitative discussion. Therefore, in order to understand whether stocks or real estate is the better investment, we now need to understand how much a $1.2 million condo can make in 15 years after subtracting all the cost. If you're new here, my name is Daryl, and in this channel, we talk about real estate in Singapore. If you're watching this video, then you're probably interested in optimizing your finances when it comes to investments, and may also be interested in some of my other videos which talk about the qualitative differences between stocks and property, what specific fundamentals make some projects such a good investment, and why rental income may not be as good as what it seems on the surface. So remember to like and subscribe if you want more such unbiased property videos. Let's say you purchase a condo for $1.2 million. Assuming the property appreciates at 4% per year, its value rises to around $2.16 million after 15 years, giving you a paper gain of approximately $961K. Over the next 15 years, you also collect a monthly rental income. Let's assume it's around $3,200 and increases at around 2% annually. To also keep things simple, let's assume there is no rental downtime over this 15 years. All this adds up to roughly $664K in total rental income. That would bring your total gains after 15 years to be around $1.6 million. That looks great on the surface, but in order to understand whether stocks or real estate is indeed the better investment, we now need to understand both the upfront and the recurring costs involved when it comes to real estate. Your upfront cost for a condo like this includes the buyer stamp duty, the legal fees, and a small renovation budget for the unit. That brings your initial expense to around $55.6K. But over the 15 years, there will also be some recurring costs that you need to remember. Let's assume that the property purchase is based on a 75% loan-to-value ratio with a 30-year loan tenure. The average interest is assumed to be around 2.5% per annum. Over the 15 years would be around $273K. Assuming management fees is around $300 a month, that would add up to be around $64,000 in total. Income tax is tiered, so it can be subjective, but in order to afford a condo like this, I've assumed rental income is taxed at around the 11.5% tax bracket on the net income after deductibles. So the income tax you'll be paying on your rental income would be approximately $2K per year and $30,000 after 15 years. An investment property is also taxed differently from an own stay property. Property tax would be approximately $2.5K per year and $37.5K in total. Along the way, you also need an agent's help to rent out the place. Let's assume 1 month of rental as commission every 2 years. After 15 years, that would be approximately $22.5K. In this calculation, I've excluded any maintenance and repair costs. In addition, exit costs such as agent fees for the sales of the property is not factored in. Altogether, the recurring costs would come up to be around $416K. So here's a summary. your total gains would be around 1.62 million. But after deducting your upfront cost of 55.6k and your recurring cost of 416k, that gives you a final estimated profit of around 1.15 million after 15 years. You also notice that I did not count in my down payment and principal component of my monthly installment. That's because this money will come back to me after I sell my home, and I don't really consider them as an expense. We can count them in when we talk about things like cash flow or ROI, but not for P&L. So over the first few years, you actually be in the red due to the high upfront cost. But things start to pick up around the second or third year as rental income grows and capital appreciation kicks in. Now let's jump over to see what investing in stocks would look like. For the stock side of the comparison, I modeled investing in the S&P 500, an index that tracks the top 500 publicly listed companies in the US. Historically, it's returned around 10 to 12% per annum. It's also one of the tickers that I personally dollar cost average into. But yes, certainly there are other strategies like stock trading or picking your own stocks. But I've chosen the S&P 500 along with the dollar cost averaging method. Dollar cost averaging simply means that you invest a fixed amount of money at regular intervals, regardless of the market price, to reduce the impact of volatility over time. It requires less skill to execute and offers a more balanced risk to reward ratio for the average retail investor. We've outlined so far both the real estate as well as the stock investment option. But now let's take a step back and ask ourselves why this question matters more than ever to our generation and what has changed over the years. This is a question that many in our generation are grappling with. With higher disposable incomes and a greater exposure to financial knowledge, our thinking has evolved beyond that of our parents' generation. Back then, real estate was a default because most people simply did not know much else. But things have changed. Firstly, sky-high property prices have turned many young people away from real estate altogether. Many also question if this growth is even sustainable. And now they are exploring other alternatives to grow their wealth. And secondly, retirement planning is also starting earlier. With personal finance content being more accessible than ever, people are thinking ahead. At the same time, there is a noticeable shift away from the traditional career path towards lifestyle freedom. More people want flexibility and they don't want to be tied down by a 30-year mortgage and a heavy monthly installment. This is a crossroads that many of us are standing at. And at the end of this video, you have a better understanding of the profit and loss of each option. We've seen how the S&P 500 is probably the best comparison and how it can help many in our generation attain financial freedom earlier. Therefore, in order to understand whether stocks or real estate is the better investment, the next thing that we need to look into is the potential returns from the S&P 500 if you were to put in the exact same amount as your $1.2 million condo over the same 15-year time frame. But first, we need to talk about an element that catches many Singaporeans off guard, and that is the CPF. CPF plays a major role in terms of property affordability for most Singaporeans. You can use your CPF ordinary account for the down payment and for the installments. Conversely, your CPF OA funds can also be invested in unit trusts, tracking indices like the S&P 500. Just like in property, your CPF investment scheme returns are only accessible after the age of 55. But unlike stocks, real estate has the potential to generate a positive cash flow if your monthly installment is lower than your rental income, either due to the fact that rents may have risen over time or maybe because you put in a larger down payment. In short, you don't have to use your CPF, but you can use it for either of the two options. Now on to the numbers behind how much the S&P 500 can potentially return after 15 years. This is going to be slightly different from how most other channels do this. Most other channels would simply take a simplified calculation of taking a base amount and extrapolating it over 15 years, adding a percentage gain over the years. But we're doing this slightly differently because the intention is to do a like-for-like comparison between stocks and real estate. So here's how we're going to do it. Let's assume that instead of buying a property, you would take the sum of the down payment and all the upfront condo cost and invest it in the stock market on day one. Then for the next 15 years, you continue to invest the same amount of cash that you would have used for your property-related expenses, such as your mortgage, both in terms of the principal component and the interest component, MCSE fees, and all the other taxes involved. This approach mirrors the cash commitment of owning a property, but redirects it to stocks instead. And over time, let's assume an average of an 8% annual return, ignoring any FX fluctuations. That means your portfolio grows to around $2.75 million after 15 years. But not all of this $2.75 million is profits. After subtracting your invested capital from the end portfolio value, your net profit comes up to be approximately $1.16 million. Unlike real estate, stocks theoretically start off in the black since there are no high upfront fees. Stocks might not really overtake real estate within the first 5 to 8 years, but eventually they catch up and surpass property over the long term. This raises the real question, why does property start off stronger but loses to stocks in the long term? To answer that question and to understand which is the better investment, we need to understand the true growth drivers behind each of the options. For property, the main lever is leverage. At the start, you only commit the down payment and the buyer's stamp duty, which is around $355K, yet you control a $1.2 million asset, effectively leveraging your money up to 3 times. But over time, as you repay your loan, your overall leverage decreases. This boost from the leverage is strongest early on but gradually loses steam over time. While there are options to combat this, such as either refinancing or upgrading your property, those are topics for a different day. For stocks, the main lever is the high growth. Early on, with relatively little capital invested, the 8% annual return doesn't generate a very large absolute gain. But as your principal grows over time, that 8% compounds more and more, and that is the magic of compound returns. On paper, stocks deliver a higher P&L, $1.61 million versus $1.15 million from property, a difference of nearly $500,000 over 15 years. Now that's a meaningful gap, assuming you don't refinance and redeploy your extracted equity, or you don't upgrade your condo. But choosing between stocks and property is not just about chasing the bigger number. It is also about understanding what suits your goals, what you understand better, and what suits your personality, temperament, and discipline. The S&P 500, yes, in theory, offers a higher return, but it comes with volatility and also requires a degree of emotional control. Property, on the other hand, can give you the assurance of a forced saving through your monthly mortgage installment and the comfort of owning something tangible. You probably also want to consider the effort involved. Stocks are also more passive but also require the conviction to stay the course of dollar cost averaging. There is no universal right answer here, but the right asset depends on what you value more. If you need help drafting your own plan, drop me a message. And if you now want to understand the qualitative aspect between these two investment options, then you may like my video over here. And if you like this video, you may also be interested in another video which talks about specific investment fundamentals and what makes this condo in Ang Mo Kio such a profitable investment. As always, if you like this video, remember to like and subscribe.